Let me tell you something that almost nobody in the financial press is leading with this morning. Gold just dropped for the 9th consecutive day. Asian stocks are sliding toward correction territory for the 3rd straight session. Nasdaq futures hit their lowest level since September. The S&P 500 is catching down to a crash it missed when Bitcoin already absorbed in February. Bond yields are rising. Oil is surging. Goldman Sachs just raised its crude forecast, citing what it called the largest supply shock in history. Everything is selling right now, and Bitcoin is selling the least. Let that sink in for a moment before you do anything else today, because the story being told about this market right now, the story about crypto crashing, about fear dominating, about everything falling apart, is missing one number that changes the entire narrative. Bitcoin is holding $68,300 this Monday morning, down roughly 6% over the past week. That's real. That's painful, and I am not going to pretend otherwise. But gold, the supposed safe haven that has been called digital gold's smarter, more mature older sibling, is sitting at approximately $4,360, down 9 days straight, its longest losing streak in years. A market that was surging to all-time highs just months ago is now approaching a technical bear market, off nearly 20% from its January peak. And this morning, Bitcoin is outperforming it. This is Monday, March 23rd. And the next 7 days may be the most consequential stretch of the entire second quarter. Here's what you need to understand about what's actually happening in global markets right now, because the context matters enormously. Trump's 48-hour ultimatum to Iran expires today. He threatened to obliterate their power plants if the Strait of Hormuz is not fully reopened. That deadline is live as you watch this. This is not a hypothetical risk. It is a ticking clock with two very different outcomes sitting at the end of it. If de-escalation happens, even partially, the markets that got hammered over the weekend have significant room to recover quickly. Bitcoin sitting at a fear and greed index reading of 10, extreme fear, with a price that has held above key support levels, is not a broken asset waiting to fall further. It is a coiled spring sitting in historically oversold territory. Every single time the fear and greed index has been this low, it has preceded a local bottom. Not always immediately, not always cleanly, but the pattern is unambiguous across Bitcoin's entire history. If escalation happens, if strikes actually begin on Iranian energy infrastructure, the picture changes. Analysts are pointing to the $65,800 channel bottom as the first serious test, and $60,000 as the next level below that if the selling pressure intensifies and the macro environment deteriorates further. That scenario is real. I will not pretend it isn't. Cryptocurrency markets are volatile, unpredictable, and carry enormous risk. Never invest more than you can afford to lose. This is not financial advice, but here's what I want you to notice. Even in the escalation scenario, even with oil surging past $110 a barrel and Asian equities nearing correction territory and Goldman Sachs flagging the largest supply shock in history, Bitcoin this morning is not at $60,000. It is at $68,300. It held through the weekend shock. It held through the Asian market open. It is holding while gold falls for the 9th day and Nasdaq futures hit September lows. Now let's talk about what the smart money is actually saying about this environment, because this is where the script changes from the one being written in the headlines. Bernstein, $867 billion in assets under management, one of the most respected research and brokerage firms on Wall Street. This week, they reiterated their $150,000 Bitcoin price target for end of 2026. And the framing they used is worth paying close attention to. They called what we are experiencing right now, and I am paraphrasing their note to clients directly, the weakest Bitcoin bear case in the asset's history. Think about what that means coming from an institution of that size. Not from a YouTube channel, not from a Twitter influencer, from analysts led by Gautam Chugani who have clients with real money at stake and reputations on the line. They reviewed the current drawdown against every prior Bitcoin bear market and concluded that none of the structural failures that defined previous downturns have appeared. There have been no exchange collapses, no hidden leverage cascades, no systemic insolvency events. The Bitcoin network continues to run. Hash rate continues to operate. Settlement finality, node participation, and global infrastructure remain completely intact. Their argument is direct. Previous bear markets were caused by things breaking. Mt. Gox broke. 3 Arrows. Capital broke. FTX broke. Terra broke. This time nothing has broken. What we have is a crisis of confidence driven by macro conditions and geopolitical shock. And Bernstein's position is that a confidence-driven pullback occurring within a structurally stronger ecosystem, one with $104 billion in ETF assets, institutional treasury programs, and regulatory frameworks being built right now, is a fundamentally different risk environment than any prior Bitcoin winter. From current levels, Bitcoin would need to gain roughly 117% to reach $150,000. Bernstein does not suggest that happens in a straight line. They are explicit about that, but they see no evidence that the trajectory has changed, and Standard Chartered sits at the same price target, reinforcing the growing institutional consensus. Now, I want to show you something that the broader market coverage is completely missing, because this is about what is happening underneath the surface while the headline numbers dominate. Look at what smart money is doing versus what retail is doing right now. Bitcoin's daily volume is over $31 billion. This is not a dead market. This is a market where people are actively repositioning, and the direction of that repositioning tells you everything. The 36 crypto data shows Ethereum down 3.5% and Solana down 3% on the day, with altcoins taking sharper losses proportionally than Bitcoin. That is exactly what happens when smart money rotates toward the highest quality, most liquid asset in the ecosystem. Bitcoin outperforms in downturns because it is where serious capital goes when it wants to reduce risk within the crypto space without exiting entirely. The weaker hands go to cash. The disciplined hands go to Bitcoin. At the same time, a specific pattern is emerging in the smaller token space. Mid and low cap assets are seeing capital rotation. Some tokens posting 30%, 50%, even 89% gains in the same session where majors are declining. This is not random. This is a section of the market where traders with higher risk tolerance and shorter time horizons are actively hunting short-term asymmetry. Capital is not leaving crypto. It is rotating within it, finding pockets of opportunity in a market where dislocations are creating gaps between price and value. That rotation pattern, notably, is exactly what precedes a broader recovery. It is the behavior of a market transitioning rather than collapsing. But the single most important number you need to have in your head this week is not the current price. It is $13.5 billion. That is the total value of crypto derivatives contracts expiring on Deribit on March 27, 4 days from now. This expiry is one of the largest options events of the year, and the directional impact of what happens between now and Thursday cannot be overstated. Options expiry events create what traders call gravitational price pressure. The max pain levels, the price zones where the maximum number of contracts expire worthless and therefore benefit the institutions and market makers who wrote them, act as price magnets in the days before expiry. Those mechanics, combined with the Trump deadline, combined with the fear and greed index at 10, combined with a derivatives market that has already shed 55% of its peak leverage from $94 billion down to approximately $44 billion, creates a compressed window of enormous potential movement in either direction. If de-escalation occurs and sentiment shifts even modestly, the combination of extreme oversold conditions plus $13.5 billion in options of gravity, plus the short squeeze mechanics we identified in the liquidation heat map, data could produce a violent, fast recovery move. The CoinGlass liquidation heat map clearly shows dense clusters of open short positions sitting above current price. Those shorts getting squeezed as Bitcoin pushes higher would accelerate any upward move dramatically. If escalation occurs, those same mechanics apply to the downside, amplifying selling pressure through forced liquidations. Either way, this week is not a week to be inattentive. It is a week to watch the data every single day and understand what the moves mean before reacting to them emotionally. There is one more structural data point I want to give you because it belongs in this picture. Only 57% of Bitcoin supply is currently in profit. Let me say that one more time, 57%. That means 43% of all Bitcoin holders are currently underwater on their positions. Historically, this level has been associated with early bear market environments. It is a sobering number, and I want to be honest about what it means. But here's the other half of that picture. That same metric, when it appeared in previous cycles, also marked some of the most precise accumulation windows in Bitcoin's history. When the majority of holders are not in profit, the people who are adding to positions are not the emotional crowd. They are the patient ones, the strategic ones, the ones who have seen this before and understand that the supply mechanics of a 21 million coin asset do not change because the geopolitical calendar got complicated. The Clarity Act, the legislation that would finally establish clear regulatory frameworks for digital assets in the United States, is facing an end of April legislative deadline. What happens with that bill between now and the end of April is one of the most consequential near-term catalysts for institutional capital flows. If it passes, the legal runway for pension funds, endowments, and bank products to engage with Bitcoin opens significantly. Prediction markets were recently pricing an 80+% probability of passage. That context sits behind every price move this week, whether the headlines mention it or not. So here's what you are actually looking at as Monday opens. The Trump deadline expires today. The $13.5 billion deribit options expiry lands Thursday. The Clarity Act faces its end of April window. Bitcoin sits at $68,300 with a fear and greed index at 10. Smart money net long on LiqTerminal. Retail net short at minus 397 and $104 billion in ETF assets that have not collapsed. Gold is falling for the ninth straight day. Asian stocks are nearing correction territory. And Bernstein, $867 billion in AUM, is publicly on record calling this the weakest bear case in Bitcoin's history while maintaining a $150,000 price target by year end. None of this means the bottom is in. It might not be. $65,800 could get tested. $60,000 is a scenario that serious analysts are not dismissing. Macro risk is real, and this week could bring news that changes the environment quickly. Please understand that clearly, and please treat everything in this video as education and context, not as financial advice. But here's what I know about moments like this one. The people who look back at this week with clarity will not be the ones who reacted to the fear and greed index reading. They will be the ones who understood the difference between what is happening and what it feels like is happening, between price and structure, between noise and signal. The 48-hour clock is up. The derivatives expiry is 4 days away. The legislative window is open. What happens next will define whether Q2 2026 is the beginning of a relief recovery or the beginning of deeper capitulation. And the data right now is not yet written. It is being written. The question is whether you understand it as it unfolds. Drop a comment, bull case, bear case, or watching. I want to know where this community actually stands at this exact moment in the cycle. Not in 6 months. Now, send me the next one.